What's up, you guys? Tommy Shaw here, and today what I'll be talking about is 7 points to reducing risk in real estate. So step number one, or first point, is the number of units. If you're buying a single family home or you're buying a 16-plex, if you're buying a single family home and one is not rented, that's 100% vacancies. While if you only have one rent that is unoccupied at 16 units, that's 1/16 of the risk. So you're still getting 15 other units that are giving you money, because real estate, you make money when you rent it out. All right. The second point is use less leverage. Leverage is equal to financial risk. So what do I mean by using less leverage? This means you have to put a bigger down payment. Okay. If you expect the market to correct by 40%, have at least 40% down payment. So that way, if the market goes down 40%, you're still at zero and the banks are still going to lend you money. The third point, buy for cash flow. Okay, I look at properties that can generate a 10% cash flow on the money that I invest, cash on cash returns. How? You need to buy at the right price. If you overpay for something, then you're not going to satisfy this cash on cash returns. So essentially, if a cash flow is everything that's left after your operating income, operating expense, and then you pay your mortgage, and whatever's left at the total end, that's your cash flow, or essentially the kind of dividend that you're giving yourself. And I'm looking for a 10% cash on cash returns. It could be higher, but I don't want it to be lower, because that's my safety. That's where I can control that money and I can invest in other properties. Buy with a high debt coverage ratio. Why? Because this is how much money is above your current payments. So if you are having a net operating income over your yearly payments of mortgage payments, the banks are looking for it to be at least 1.15. That means you have 115% above the mortgage payment. But I look at properties that can give at least 1.35. And when a bank sees a debt coverage ratio of 1.35, it's essentially guaranteed that you're always going to be able to make your payments. Now, point number 5, have at least 6 months of cash reserve. I'm talking about 6 months of cash reserves to pay all of the expenses. I'm talking about the expenses of the operating expense of the business or the real estate and the mortgage payments. So have at least, if it's $10,000 a month, have $60,000. I know this isn't good for inflation or returns, but I'm talking about reducing risk. I'm not talking about maximizing returns. I'm talking about how to reduce risk in real estate. So have at least 6 months of cash reserve. So if something happens, you can still go see the bank, you can still refinance, you can still get the best interest, because a bank, what it looks at most of the time is how much money you have in the bank account. They're not always going to look at all the assets and liabilities and equity, because they're saying that asset can go down in price and that equity can disappear. What they're looking at is how much money you can go without working, or if something happens, you can still make your monthly payments. Okay? Don't speculate. When you go into real estate, it's so risky. Real estate, you can lose everything. So don't speculate on price increase. If it doesn't make sense when you're buying a property, don't buy it. I never buy a property because I expect it to go higher in price. I'm buying a real estate property because I believe that the return on investment is good and the cash on cash returns are great. Okay? The 7th point, reduce mortgage payment. You can do this by lowering interest or extend it to a higher, longer term. If you're taking your mortgage on a 15-year term mortgage, what's going to happen is that essentially it's going to decrease your debt coverage rate.